All right, welcome to this explainer, where we're going to construct the absolute blueprint for a successful audit. Listen, if you're an ACCA student or working toward your degree right now, you already know that auditing isn't just about showing up with a calculator and looking at some numbers. It's high-stakes architecture. Seriously, a single mistake can cost millions and completely destroy reputations. And that is exactly why meticulous preparation is everything. Today, we're breaking down Chapter 6 on audit planning. We'll be digging into the rules, the strategies, and the essential frameworks that make an audit actually work. We're going to treat this phase not just as a boring set of rules, but as the make-or-break foundation of a real-world auditor's job. So, let's get right into it. Here's our roadmap for today. We'll start with 1, purpose and benefits. Move into 2, audit strategy versus audit plan. Cover 3, interim versus final audits. Tackle 4, fraud and error. Look at 5, managing engagement quality. And finally, wrap up with 6, essential audit documentation. This overarching architecture perfectly illustrates how everything, from your top-level strategy down to your specific documentation, your quality management, and your vigilance against fraud, is entirely anchored around this central concept of planning. These components don't exist in a vacuum, you know? They feed directly into one another. If you fail to build this interconnected plan, you are fundamentally planning to fail your audit engagement from day one. Section 1, purpose and benefits. So why do we actually plan an audit? Well, to answer that, we turn to ISA 300. Now, for anyone new to the exact terminology here, ISA stands for International Standard on Auditing. These are basically the globally recognized rules of the game. And ISA 300 clearly states that the objective of the auditor is to plan the audit so that it will be performed in an effective manner. Think of it kind of like building a skyscraper. You wouldn't just hand a team of builders a pile of bricks and tell them to start stacking, right? You need a legally binding, mathematically sound blueprint. Audits are incredibly complex, highly risky, and very, very expensive processes. You absolutely cannot just wing it. And that's exactly why ISA 300 strictly mandates this planning phase, to reduce the risk of issuing an inappropriate audit opinion down to an acceptable level. Planning really acts as a vital safety net. By dedicating time up front, it allows you to devote the appropriate attention to the most important, highest risk areas of the business. For example, if you know the client has highly complex financial derivatives, your planning ensures you select team members with the exact right capabilities. You'd assign a seasoned senior auditor to those derivatives rather than throwing a brand new junior into the deep end. Plus, it lets you identify and resolve potential roadblocks long before they have a chance to derail the entire engagement timeline. Section 2. Audit strategy versus audit plan. This visual perfectly captures the top-down flow of an audit. You never just jump straight into the granular details. The overall audit strategy is established first. That's your 10,000-foot view. Once that broad strategy is locked in, it drives an increasing level of detail, all the way down into the specific ground-level operational audit plan. So the strategy sets the approach, and the plan fills in the specific details of exactly how that overarching strategy will actually be achieved on a day-to-day basis. Definitely remember this rule of 3 for your exams. The audit strategy determines the scope, timing, and direction of the audit. It dictates your broad resource allocation. On the flip side, the audit plan dictates the nature, timing, and extent of your actual specific testing procedures. Let's make this a bit more concrete. Say the strategy dictates that we need to audit the client's inventory on December 31st using external valuation experts because it's a high-risk area. Well, the plan takes that broad directive and says exactly how many boxes of inventory we're going to count, which specific warehouses we're visiting, and literally who on our team is going to be holding the clipboard. Section 3, interim versus final audits. Now, how do we divide up this massive workload to make it manageable? It's really vital to grasp that these are not 2 separate audits. That's a super common misconception. They are actually 2 stages of the exact same engagement, straddling the client's financial year-end. That year-end date is your critical pivot point. Everything builds toward that specific date, and you still only issue one single auditor's report at the very end of the whole process. The tactical advantage of splitting it up like this is massive. The interim audit happens before the year end. It gives you early warnings of specific problems and lets you thoroughly test the company's internal controls. And why does that matter so much? Well, imagine if your interim audit proves the client's automated payroll software is functioning flawlessly. Because you did that work early and proved the control risk is low, you don't need to manually check a mountain of individual employee timesheets during the high-pressure final audit stage. You've just made the whole final process vastly more efficient. Section 4, fraud and error. Before we look at what actually causes the numbers to be wrong, we have to clearly define what a misstatement actually is under ISA 450. It's simply any deviation from the applicable financial reporting framework, whether it's the wrong financial amount, an incorrect classification on the balance sheet, or, and students forget this one all the time, a completely missing text disclosure in the footnotes. If a required disclosure is omitted, that is just as much a misstatement as doing the math wrong. So, misstatements arise from two sources: fraud or error. The distinguishing factor here, and trust me, this is a favorite exam trap, is purely intent. Fraud is an intentional act involving deception to gain some sort of unjust advantage. Error, on the other hand, is an honest, unintentional mistake. Think of a simple oversight or just misinterpreting a fact. It really all comes down to what is going on in the person's head at the exact time the misstatement was recorded. So, whose job is it to actually stop the fraud? Management and those charged with governance hold the primary responsibility for prevention and detection. However, the auditor's job is to obtain reasonable assurance that the statements are free from material misstatement. And to do this, you absolutely must maintain professional skepticism. A great little phrase to remember is that auditors are watchdogs, not bloodhounds. We're proactively looking for issues with professional skepticism, but we aren't automatically assuming everyone in the building is a criminal. You just have to recognize that even in a perfectly planned audit, there's always an unavoidable risk of missing a well-concealed, highly sophisticated fraud. So stay alert.
Section 5. Managing engagement quality.
Because executing your plan poorly is honestly just as bad as having no plan at all. Quality engagement performance under ISA 220 relies on a highly structured 1-2-3 punch. First, direction. Directing the team by informing them of their specific responsibilities and the nature of the entity's business. Second, supervision. You can't just hand out orders and walk away until the review. Supervision ensures mistakes are caught while the audit is actually happening. You're tracking issues and coaching the team in real time. And finally, review. A rigorous check of the completed work to ensure the objectives of the audit have actually been achieved. Section 6. Essential audit documentation. Now, if you've ever worked on an actual audit, you know it often feels like 90% of the job is just documenting what you already did. You might legitimately wonder, especially when you're buried under a mountain of paperwork at midnight, why auditors are so utterly obsessed with keeping extensive working papers. What's the actual real-world objective here? Well, documentation isn't just bureaucratic, busy work. It is your shield. It provides the concrete evidence supporting your final auditor's report. It proves to regulators that you complied with all those ISAs we've been talking about. Plus, it enables the engagement team to be directly accountable for their specific work. Now, it's crucial to understand how we organize this shield. We split these papers into two highly distinct files, the permanent file and the current file. Your permanent file holds information of continuing multi-year importance. We're talking things like the company's legal constitution, long-term lease agreements, or historical background that you're going to reference year after year. Your current file, on the other hand, only contains information relevant to this specific year's audit, like this year's bank statements, management accounts, and your active daily working papers. When we zoom in on the current files specifically, notice how the working papers are structured exactly like a funnel. You start at the wide top with high-level lead schedules that agree directly to the final financial statements. Then, you step down into narrower backup schedules that break down the subtotals. Finally, at the very bottom of the funnel, you get down to the meticulous audit work programs. These show the exact objectives tested, how samples were selected, exactly who did the work, and the final factual conclusions drawn. I want to leave you with this final provocative thought as we wrap up Chapter 6. We've seen how absolutely everything, from complex fraud detection all the way to meticulous quality review, rests entirely on the planning phase. If that foundational blueprint of planning is flawed from day one, how can any shareholder, investor, or regulator ever truly trust the final audit opinion resting on top of it? Planning isn't just a step in the process. It is the absolute bedrock of trust in the financial system.